Good day, everyone. Welcome to our webinar for June month. We start, as usual, in America, and I'd just like to spend a little bit of time talking about Wall Street and what's been happening on the S&P 500, which is, of course, the chart that you see in front of you on your screen. The important thing here is, if you want to understand what's going on Wall Street right now, you've got to understand the concept of breadth. The Standard & Poor's index, the S&P 500, reached a new cycle high in the last week. And you can see there on the screen, on the right-hand side of your screen, it's at that cycle high. And that is well above the long-established support and resistance level at 4170, which you can see I've got marked on the chart there. The resistance was broken. But as you can see here, this red line, which is the 300-day moving average, is still trending down. Can you see that? That's important. So the question arises, is the bear trend over? Is this the start of a new bull trend? We think not. The reason we think that is because the S&P 500 has gone higher on very few high-tech big cap market cap shares. Most of the shares in the S&P 500 are either flat or falling. The breadth of the market refers to how widely a move is being followed. One way to measure that is to look at the percentage of companies that are beating the S&P 500. Right now, only 20.3% of shares on the S&P 500 are above the index, which means that about 80% are below the index. The index is being dragged higher by a few very large cap shares. For example, Apple and Microsoft together account for about 14.5% of the S&P 500 by market cap. Both of them are rising rapidly. If we add in the next 7 companies, that is Alphabet, Amazon, Nvidia, Berkshire, Meta, and Tesla, then we have just 8 brand name companies accounting for about 28.6% of the S&P 500's move this year. The lack of breadth in this rise in the market can also be seen if you compare the S&P 500 to the Dow Jones or the Nasdaq. The Dow Jones, of course, is a simple average of the 30 largest companies trading on Wall Street. It is only up 1.9% this year. So far from the 28% that the S&P 500, that the S&P 500 is up, this one is only up 1.9%. Sorry, I need to go over that again. The S&P 500 is up 12% this year, not 28%. But the Dow Jones is only up 1.9% because although it includes Apple and Microsoft, they are only given exactly the same weighting as the other 28 shares in the Dow Jones. The S&P 500, of course, is a weighted average of the 500 largest companies on Wall Street, including Apple and Microsoft, and that, of course, as I said, is up 12% so far this year. The Nasdaq is 2,500 companies, but they are non-financial companies and they are mostly high-tech. It is also a weighted average, and that is up 26%. So you can see the Dow is up 1.9, the S&P is up 12, and the Nasdaq's up 26. Historically, upward trends on the S&P 500 that are not supported by at least 50% of the shares in the S&P 500 do not last. The upward trends, they are like the seed that fell on the stony ground. They tend to shoot up and die in the sun. Nvidia is one of those companies that's dragging the S&P 500 higher. And that company it looks way overpriced at the moment on a PE of 223.8. That's a crazy price earnings ratio. And Wall Street as a whole, as an average, has got a PE of around 20 to 30. So to have a PE of over 200 is unsustainable in my view. Nvidia has gone up 167% this year alone. We believe that the bulls in this market do not understand the concept of market breadth. They simply have not been around long enough to understand the danger. Technically, of course, the S&P 500 gave a golden cross buy signal over here on the 1st of February this year. But the S&P 500 has only really risen about 3.7% since then. We continue to believe that this golden cross was probably a false signal. One of the major factors that is touted by the bulls all the time is the impact of artificial intelligence, or AI. AI is expected to bring major improvements in productivity to a lot of companies, especially for NVIDIA, which is at the forefront of that AI field. We agree that AI is very important and probably will be positive, but we do not believe that it is important enough to overcome the cumulative effect of the interest rate hikes in America. To us, the surge in optimism around AI is very similar to the 1998 dot-com boom. At that time, everyone became very excited about the benefits of the internet and the inevitable productivity that it would bring. That boom ended in a crash, which saw most of those IT shares fall at least 90%, and many of them went into liquidation. So we urge you to view the current upward trend with some trepidation. If you are invested or you intend to invest, make sure that you have a strict stop-loss strategy. All right, let's move to the U.S. economy. What we are seeing with the economy now is that it is not really responding sufficiently to interest rate hikes. And this can be seen particularly in the payrolls, in private payrolls. Private payrolls were up 296,000 in April. In other words, the U.S. economy generated nearly 300,000 new jobs in April, and that was expected to be 133,000. Most analysts were looking at 133,000. It's also well above March's 142,000. This does not look like an economy that's shrinking. But the interest rates, the rising interest rates, are having some impact. We saw first quarter GDP grew only by 1.1%. Consumer spending was down 1.2% year on year in April. The big losers were furniture, luxury fashion, home improvements, retail, and clothing. And you mustn't forget that 70% of GDP in America comes from consumer spending. Unemployment benefit applications from higher income groups were up 40%. That's interesting, higher income groups. So that shows that this recession, if it is a recession yet, is definitely in the white-collar area so far. Layoffs have been at Google, Microsoft, Disney, Meta, and Tesla. The Consumer Price Index in America rose by 4.9% in April, slightly less than was expected. But core inflation, which excludes, of course, food and energy prices, was up 5.5%. It's very, very sticky. It's showing no signs really of coming down significantly, despite the hike in interest rates. And this, of course, is the Fed's problem. This is why they may be considering further rate increases. The discussion in the Fed is not about pivoting, in other words, reducing interest rates, but it is about pausing the hike in interest rates or raising again. That is where the discussion is now. Retail sales in April were only up 0.4% against expectations of 0.8%. So those are factors which show that that interest rates are having some effect, but not enough really to control inflation, to bring inflation down to the Fed's goal of 2%. Of course, we had this huge debate over the debt ceiling this month, and that had an impact on the S&P 500, first depressing it when it was thought that there would not be a deal, and then boosting it when a deal was finally agreed. Just some information for you here about this debt ceiling problem. It comes up about once a year. In fact, it was first established in 1917, and since then the debt ceiling has been renegotiated 103 times, upwards, of course, each time. And it always happens. The deal always is agreed, sooner or later. Sometimes there's a good deal of brinkmanship by one or other of the two parties, the Democrats and the Republicans, but inevitably, the deal is signed, and the effects on the stock market are very brief. So when this happens again, and it will certainly happen again next year or the year after, just be aware it's not really a major factor on the stock market. Seasoned investors know that, but novices and beginners don't. And of course, the debt ceiling and the crisis and all that is a great opportunity for the press and the media to have a field day, and they talk about what will happen if a deal is not reached. But the simple fact of the matter is a deal has been reached 103 times in the last 100 years, so it's very unlikely that it won't be reached. Only naive and inexperienced investors get caught up in that furor. All right, I'd like to talk a little bit about what's going on in Ukraine right now. President Zelensky continues with a very strong public relations campaign. He went to the G7 meeting in Hiroshima and said all the right things. Of course, he's always pleading for more military support and more sanctions on Russia. When we look at the battlefield, it seems like there's a certain amount of a stalemate there, and there's been no ground gained on materially by either side. But that stalemate has been broken by a series of attacks inside Russia. This could be very significant. You mustn't forget that Putin came to power 23 years ago because he could protect the Russian people. He was perceived as a person who could protect them. Now it suddenly looks like he can't. Ukraine has 31 companies that are producing long-range drones, and the Russian separatists are making cross-border raids. This is forcing Russia to redeploy troops away from the front line in Ukraine in order to protect their own borders. At the same time, Prigozhin, who is the head of the Wagner group of mercenaries, has been openly critical of the Russian Defense Force. No one has ever dared in the past to be so openly critical. It appears that Russia can no longer gain further territory in the battle either. That's what we are seeing. They don't seem to have the resources to be able to make any headway at all. Instead, they are preparing for Ukraine's counteroffensive, which is expected any day. We believe that Putin cannot survive another major defeat, especially if that involves the loss of Crimea, which I think it will. And without him, this war, of course, would almost certainly come to an end. So we expect that might well happen sometime later on this year. If the war ends, it will be a great boost for the world economy. But by then, we expect the US economy at least will be in a serious recession. Okay, let's look at South Africa now, and I'd just like to start off by looking at a few points in the political area. First of all, the DA ran a poll of 1,700 people done by telephone. They assumed that that poll assumed a two-thirds voter turnout, and it showed that DA support would rise from 27% to 37% in Gauteng, and from 13% to 20% in Natal. ANC support, on the other hand, would fall from 50% that they got in 2019 down to 34% in Gauteng. The election, of course, is still a while away, so these numbers could change, but they are an indication of how things stand right now. It looks like the ANC will lose its majority in Parliament at the next election. And this, of course, means that it will have to make a compromise, either with the DA or with the EFF. Of course, another major factor that's come up in this last month is South Africa's neutrality in the Ukraine war, which is now seriously open to question, following, first of all, the docking of a Russian ship in Simonstown, secondly, the news that a high-level South African team is in Russia at the moment to discuss combat readiness, whatever that means. And then thirdly, the suggestion that Putin may have diplomatic immunity from arrest in South Africa if he comes to the BRICS meeting in August. All of these things are seriously dangerous as far as South Africa is concerned. We enjoy a privileged trade status with both Europe and America. This may now be in jeopardy, and that is something that we can ill afford, especially if you add it to our recent grey listing and also the load shedding that we're enduring. So that's a major factor. The expulsion of Ace Magashule from the ANC now seems to be inevitable. And of course, that will bring to an end the idea of radical economic transformation. Magashule, of course, has been a strong supporter of Jacob Zuma and a leading proponent of radical economic transformation. We think SA, South Africa, will be a better place without this populist concept. The ANC government's inability to control and run large state-owned enterprises has now become very, very clear. They have had the costly failures at both Eskom and Transnet Rail, and they've also been trying to update their financial management system for 10 years at a cost of 2.4 billion rand so far, with no significant improvement. Added to that is the long track record of failures like SAA, Denel, the South African Broadcasting Corporation, and the Post Office. We believe that the proposed National Health Insurance Scheme will turn into a similar costly fiasco. It could lead to a flight of top-level doctors out of South Africa, again, something that we could ill afford. Finally, I'd like to just comment briefly on our Minister of Water and Sanitation, Senzo Mchunu. He has proposed that new rules that would require farms to be owned 25 to 75% by black people in order for them to qualify for a water license. This is an insane idea in our opinion, and it will endanger many farms. Most farmers have a large finance facility with a bank, and that bank is secured against their farms, secured against the collateral of their farms. Now, if their water rights are lost, then obviously that collateral drops in value so sharply. This, of course, could put a lot of farmers out of business, and it endangers South Africa's food security. It's noteworthy that the same minister who's responsible for the outbreak of cholera in Hammanskraal is the person who's dealing with this matter, Senzo Mchunu. He's the Minister of Water and Sanitation. Now in Hammanskraal so far, we've got 23 people dead from a disease that is completely unnecessary. It is a result of pollution of the water supply by sewage. Maybe the minister thinks that he can obtain some economies of scale by combining water and sewage, but I can just tell you that in the first world, this is not the case. We've discovered that this is not the case. The ANC inherited a perfectly working water and sewage system in 1994. It is now completely run down and ineffective, with sewage pouring into our rivers in lots of places. The water quality is dropping sharply, and that, of course, is why we get cholera. All right, let's turn to South Africa's economy. We had an interest rate hike of 0.5% since I last spoke to you. That was not enough to stop the rand slipping below 20 rand to close to 20 rand to the US dollar. And the Reserve Bank has warned of further declines in the rand, mainly because of load shedding, the increased level of load shedding. So interest rates so far have gone up by 4.75% in this hiking cycle, which should be compared to America's 5% that they've hiked interest rates. We, of course, have to keep our interest rates in line with America in order to protect the yields on our long bonds. But rate hikes increase the probability that South Africa will now go into a recession. The consumer price index fell to 6.8% in April, but core inflation rose to 5.3%. This indicates that the Monetary Policy Committee is being successful in controlling inflation, but of course the weakness of the rand is a huge inflationary factor. And some of the weakness is being caused by a shift to risk on in first world markets. The Reserve Bank is now saying that inflation this year, 2023, will be around 6.2%. ABSA produced its Production Managers Index, the Production Managers Index, PMI, and that in April was 49.8, slightly better than March's 48.1, but still contracting. But in our opinion, this number is pretty good considering the level of load shedding that we're enduring. It indicates that manufacturing is adjusting and setting up their own power supplies in many cases. ABSA says that GDP growth this year will be about 0.3%. The Reserve Bank reckons 2.2%, and the IMF comes in with 0.1%. BankServe, in their index which measures take-home pay, said that take-home pay in South Africa was down 4.2% year-on-year in April, over the April of 2022. So the average South African household took home 14,500 Rand in April, compared to last year, April, when they took home 170 Rand. If you add inflation to that 4.2% drop in take-home pay, then it means that South Africans were 11% less wealthy or less well off this year than they were last year. This, of course, causes a reduction in consumer spending, and it further reduces the ANC's support in next year's election. Unemployment rose slightly, with 180,000 people losing their jobs. We now have just under 8 million people unemployed, or about 33% of our adult population. Youth unemployment, of course, is much worse at around 62%. Load shedding is forcing businesses to retrench and cut pay levels. Mining and manufacturing have been the worst affected and let go 85,000 people in the period. In all the doom and gloom, though, there are some surprising pieces of good news. New car sales were up 15.6% in May, on top of April's 10%. And this is after a 50 basis point hike in interest rates, which is quite surprising. Tourism. We had 2.1 million visitors to South Africa in the first quarter, 387,000 from Europe and 104,000 from America. The rest of Africa produced 1.6 million visitors. Foreign direct spending was up 144%, so tourism is doing well. Amazingly also, Standard & Poor's didn't downgrade us, despite a sharp deterioration in energy management and also the problems that might arise from our relationship with Russia and how that might affect our trade deals with America and Europe. Only 8 municipalities had clean audits. Only 38 municipalities had clean audits out of 257 municipalities in South Africa this year. Last year, it was 41 municipalities. Clearly, municipal management is continued to get worse. Of the 38 clean audits, 21 were in DA-led Western Cape. So that gives you an idea. And this will be another factor that will impact on next year's elections, I have no doubt. The ANC has failed to fix this, exactly like the load shedding, despite years of bad audits and thousands of service delivery protests. The municipal management is still appalling in this country. Okay, let's just have a quick look at Eskom and Transnet. The probability of stage 7 and stage 8 load shedding during this winter has now been raised by Eskom. This, of course, directly impacts on manufacturing and to a lesser extent mining. Forces the private sector to reallocate resources to renewables. In the short term, over the next few years, that will be quite negative. But after that, it should be better because businesses will no longer be dependent on Eskom and their power should be cheaper and more reliable. President Ramaphosa says that 10 gigabytes of power will be added to the system soon, in the next couple of months. But most South Africans just don't believe him. He's made too many failed promises. Eskom says the cost of diesel this year has doubled, so up as far as March the 31st. Some of that, of course, is due to the fall in the rand, but most of it is due to the very bad energy availability factor that Eskom maintains. in the 50s. Eskom's debt, of course, has risen sharply to 440 billion now, and of course eventually that will be paid by taxpayers. Unbelievably, Gwede Mantashe is going ahead with building a new nuclear power plant, despite the fact that renewables are both quicker and cheaper, quicker to build and cheaper to run. The Eskom unions are demanding a 12% pay increase. Management is offering 4.5%. A strike at Eskom will clearly accelerate the shift away from Eskom to renewables. Transnet, of course, is also failing. The Durban line is only carrying about 25% of its capacity now, mainly because of extensive cable theft and poor maintenance and infrastructure destruction. Well, they're stealing everything from power lines to cables to railway lines, and that is making it impossible to run the trains. And of course, that comes back to poor policing in the end. Many companies are now being forced to transport by road, and that is 4 times as expensive as transporting by rail, which obviously affects our competitiveness in world markets. Now, recently, there has been a theft of cable on the line from the Northern Cape to Saldanha Bay. This is an 860-kilometer line, and it carries a lot of iron ore and other metals for export. Kumba has said to have lost about 10 billion rand due to Transnet problems this year. There is a plan to refurbish our old coal-fired power stations. We believe this is a bad idea and it will probably fail. Most finance companies have just stopped investing in coal altogether, so where they'll get the money for this, I have no idea. This money anyway could be better spent on renewables. The Presidential Climate Commission says that South Africa needs about 8 gigabytes of renewable energies to be added to the system per annum up until 2030. If we were able to do this, it would give us a situation where 40% of our power would come from renewables by 2030. Right now, about 7% of our power comes from renewables and 80% from coal. The Integrated Resource Plan requires 12 gigabytes of coal-fired power station energy to be removed from the grid by 2030. Okay, let's just quickly look at the rand, because that's very important these days. Sorry, let me just get this right here. I just have to take a quick look at the chart, and you'll see. I'm just going to put some more data on the screen here. Okay, there you can see I've marked on here the point where where the bear trend in America began, and then the long-term weakening trend that is obvious in the rand. And you can see for a long time now, since June of 2021, the rand has been steadily weakening against the US dollar. And this latest weakness here, which saw the rand basically go from 18 to 19, nearly to 20 rand, is due to the impact of the higher levels of load shedding in recent days. By the 11th of May this year, South Africa had more days of load shedding than the whole of last year. That gives you a picture of where load shedding is. The falling rand, of course, means higher interest rates and higher inflation. The Monetary Policy Committee is forced to raise rates to compensate. And of course, now there's this risk that Europe and America will apply sanctions to us because of our relationship with Russia. It's really an insane situation. Okay, let's look at a few companies now. I'd like to start by looking at Renet. This is a company that was that has several assets, investments. Just look at it over the medium to long term here. So this is a 5-year chart. It was falling for a long time, and we suggested that you apply a long-term trend line and wait for a convincing upside break. That came on the 16th of September 2019 at a price of 270 Rand. After that, there was a long period of consolidation, but in recent weeks and months, the share has started to go up very strongly. About 27% of its assets are its holding of British American Tobacco. And that used to be 85% of its assets, so it's come down a long way in the last 10 years. Now, almost half of its assets are in Pension Insurance Company, or PensCorp, in Britain. Overall, the company has got an 8.8% per annum growth rate compound since March 2009 when it was listed. So we think that this is a solid, long-term Rand hedge share and certainly worth your attention. The next share that I want to look at is Textainer. Textainer is one of the world's largest container lease companies. All right, let's put a bit more data in here. You can see that it made a low at 428 Rand on the 6th of July 2022 and has been in a fairly steady upward trend since then. These people have about 3.5 million 20-foot units, or TEUs. The company is listed on Wall Street, and the share is very liquid, with about 20 million Rand changing hands each day. It trades on a PE of 6.99, which looks very cheap to us for a Rand hedge share of this type. Okay, now I want to just quickly look at Avenge. Avenge has gone through quite a long stage. I'll put a bit more data on the screen. You can see it's been in a downward trend. This was once a massive construction company, basically destroyed by the government. The government stopped spending money on infrastructure after the 2010 World Cup, and then the Competition Commission hit these construction companies with about 1.4 billion Rand in fines as a result of their collusion. So that hammered the construction companies. Also, they had a lot of trouble with various contracts where they had to take expensive write-downs. Avenge now consists of two companies, McConnell Dowell, which is in Australia, and Moolmans, which is in South Africa and focuses very much on construction for the mining industry. Both companies are profitable. What is important, though, is that they recently managed to sell their company Trident Steel for 1.2 billion Rand, and that has left the company essentially debt-free. What we see now is that we've got a debt-free company which is profitable, trading on a price-earnings ratio of 3.2. That is very cheap. That is very, very cheap. It's fallen a long way. Looks like it might be starting to find a base level now at these levels. Anyway, you're not paying top dollar for it. That's my point. Okay, then I want to look at Combined Motor Holdings, CMH. This is a company which specializes in motor dealerships. They have dealerships for Nissan, Volvo, Toyota, Opel, Subaru, Lexus, Mazda, Isuzu, and Ford. They sell both new and used vehicles. Okay, let's take a quick look at the chart here. Just zoom it out a bit. You can see that for a long time this company was in a downward trend, and we again recommended that you wait for a strong break up through that long-term downward trend line. That came eventually on the 2nd of February 2021 over here at a price of about 1,489 cents per share. The share has now moved up. It's trading for around 3,000 cents per share. And we think that this is a solid business. They say that the car hire business is recovering rapidly from COVID now, and they are well diversified in the motor industry. Okay, then I would like to look at ISA Holdings. This is a small IT company. It's involved in networks, internet, security. Okay, I'm just going to take the volume off here and try and give you a bit more of a picture. Okay, what I'm seeing here is a small company trading on the AltX on the JSE. It's involved in all these different IT applications, but in the last results for the period to the 28th of February showed headline earnings per share up 34%. The important thing about this company is more than 90% of its income is what is called recurring income. So they get it every month. It's on a debit order. It comes in from agreements, contracts that they've got with their clients. And it means that before they open their doors at the beginning of the month, they're basically making a profit. That's a very nice kind of business to be in. They also, because they are an IT company, they don't have a major working capital problem. The only problem with this share, in fact, is that it's fairly thinly traded. Only about 46,000 rands worth of shares are changing hands every day. So, but that is enough for a small investment of like 10 or 15,000 rand. The share is clearly in a strong upward trend, and it's trading on a price-earnings ratio of 8.57, which is cheap. And more importantly, the dividend yield is 9.33%. So they're paying out really good dividends. The last share I'd like to look at is Sirius. Sirius is a real estate investment trust listed both in London and in South Africa on the Johannesburg Stock Exchange. Here you can see that the share was in a long downward trend. Again, we recommended putting the trend line on and waiting for an upside break. You can see that came over here on the 17th of November 2022 at a price of 1,622 cents. Since then, it's gone up. It's now trading for about 2,139 cents. This share has got 141 properties worth about 2 billion euros, mainly in office, manufacturing, and warehousing in Germany. It's listed both on the JSE and the LSE. So we think it's a good share. We think it's reasonably priced and will continue to go up. Okay, folks, that's about all I have for you today. I hope that you found something of interest there. And remember, I will be doing another webinar on the first Wednesday in July, and I hope that you will come and listen to me there. Thank you very much for listening.